Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio live in Times Square, New York City, we have Phil Mackintosh, chief economist at Nasdaq, and we're going to discuss if a slowdown in the economy is actually good for stocks. And I guess, Phil, really the slowdown is a story that's missing from the focus in the headlines. Maybe a little bit this week we're starting to hear of it, but of course it's inflation, it's gas prices. If we were to get a slowdown in the economy, could it be good for stocks?
I think the short answer is yes. And the reason is because with the focus on headline inflation, which to your point includes a lot of gas prices and food prices now, that's a lot of war inflation. What's happening under the hood is actually a lot of the economy is starting to slow down. So all that COVID inflation, all the stimulus inflation is actually starting to normalize. Supply chains are starting to normalize. Shops have too much inventory, not enough inventory. So we're starting to see things get back to normal under the hood. So the focus on the top line inflation, which really we can't do much about until the war stabilizes, is missing the point that the economy is actually slowing down on its own, way ahead of the impact of the interest rate hikes that we've been talking about the last few months.
So where is the slowdown happening?
It's happening in a lot of places. So you can definitely see in housing, although house prices aren't going down yet, the housing market is definitely slowing. There's a lot less mortgage applications. There's a lot less interest in selling of houses, whether it's new houses or secondary houses. You can see it in the manufacturing sector. The indexes of manufacturing that come back from the manufacturers were really hot. They're now less hot. And the same's starting to happen in services now too. So the companies that were like, yeah, we're expecting next month to be really, really busy are just saying, yeah, next month's gonna be good. Nothing is contracting yet, but you're definitely seeing a less hot economy.
Well, the one area that has been keeping us away from, yes, we're 100% having a recession, has been the labor market. It has been incredibly tight, and we're also starting to see business see a little bit of relief there too. What's happening with labor and with businesses?
Yeah, so you're 100% right. Like there is still 2 jobs for every 1 person looking for a job out there, but you are starting to see layoffs start to pick up. Potentially that's a sign that some of the companies are actually seeing revenues fall, margins compress, and letting people go. So that's the start of a slowdown quite often. You're also seeing the extreme wage growth, especially in like leisure and hospitality, when everyone suddenly got their vaccines and started to go on holidays. The wage increases that they've been seeing are slowing. So on the labor side, you're seeing things again coming back towards more normal levels. And then on the producer side, container freight, which had been really expensive to ship and bottlenecks at ports, is now starting to come back down to normal. Even if you look at some of the prices producers are paying to get their inputs are starting to come back down. So a lot of things are starting to normalize.
Yeah, and I think what's going to be interesting is when we get into second quarter earnings season, really in earnest, in a few weeks here in July, it's going to be interesting to see how excess inventory and costs are going to impact companies, because I feel like what we're seeing for second quarter earnings is when inflation and gas prices and food prices really started to impact the consumer, and we're seeing that extra inventory there.
Yeah, and that's partly because the supply chains delayed a lot of goods coming in, then suddenly the inventory arrived in December, sort of January this year. That affected our GDP numbers and everything. Now the companies are actually finding they've got too many goods. Everyone's switched to spending on services, and so we're starting to see some discounting. At the same time, we just talked about wages had been rising quite strongly, so Q2 earnings is going to see some margin compression quite possibly, where some of the revenues are coming down just because of discounting, costs are going up because of wages and other sorts of costs. And so it will be interesting to see with Q2 earnings whether companies are still doing better than the market certainly seems to think, because the market sell-off, if you sort of look at the price earnings multiples right now, it's pricing in an earnings recession. Like the market looks kind of cheap if you look at forward earnings based on what analysts think companies are going to earn. The market's saying, no, they're wrong. It's going to have to be a lot lower than that to justify where we're at right now.
And Phil, one more question for you. We don't have the data yet to confirm that we're in a recession, but we could in fact be in a recession now without the actual data saying that we are.
Yeah, there's a lot of indicators that say that's not true. I mean, just the fact that the labor market is so strong, the fact that we have so much money that consumers are still spending, the fact that all the things that we've been talking about slowing are still in growth mode. So it's going to feel a little bit like a recession in the sense that it's not nearly as frothy as it had been, but most of the data is still in growth mode, so not near a recession yet.
All right, Phil, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.